Welcome to The Explainer. Today, we're diving into the fascinating and honestly totally unique financial world of cooperative societies. We're going to unpack the strict statutory rules that keep these community-driven organizations accountable, transparent, and, functionally sound.
Think about this for a second. What actually happens when a business is designed from the ground up to literally eliminate the middleman? Well, we're going to explore exactly how a business functions when it prioritizes shared economic goals over traditional profit margins and how the law steps in to make sure its members stay protected.
Okay, let's kick things off by looking at the cooperative concept.
At its absolute core, a cooperative society is just a voluntary group of people working together for a shared economic goal. But the really key phrase here is democratically controlled business organization. So this isn't governed by some distant top-down board of shareholders, it's actually governed democratically by its very own members.
And this democratic philosophy means everyone chips in equitably to the capital. In return, they accept a fair share of the risks just as much as they reap the rewards of the benefits. It's a completely shared undertaking, right? If the society thrives, everybody thrives. If it faces challenges, well, everyone shares that burden too.
Now, let's move on to a huge feature of this model, eliminating the middleman.
In your standard traditional business, you often rely pretty heavily on external middlemen for distribution or services. And what does that do? It inevitably increases costs and centralizes profits right at the very top. But for a cooperative society, the absolute hallmark of its existence is cutting those middlemen out completely. By doing that, the society directly shares the economic gains among its own members. It's a real game changer.
Because this whole model of cutting out the middleman and sharing risks is so incredibly adaptable, these societies can be formed for a huge variety of purposes. We see consumers' cooperative societies, housing cooperatives, industrial ones, and even urban and rural cooperative banks. Basically, the framework can be applied to almost any sector where mutual cooperation makes sense.
But this brings up a pretty massive question. With all these shared funds, equitable contributions, and the total elimination of traditional corporate hierarchies, how do we actually keep a democratically controlled, shared risk business accountable? Like, how do we ensure the society stays honest and financially secure for all the people relying on it?
That leads us right into the Section 17 mandate.
Right, so Section 17 of the Cooperative Societies Act of 1912 creates this strict, logical, step-by-step framework for legal oversight to protect the members' hard-earned investments. It establishes an annual audit mandate, requires an examination of very specific financial health indicators, and guarantees unrestricted access to records. Let's break these down one by one.
First up, before we look at the specific auditing rules, we really need to define a vital figure mentioned in Clause 4 of the Act, the registrar. This is a person specifically appointed to perform the duties of a registrar under the Cooperative Societies Act. You can kind of think of the registrar as the ultimate guardian, ensuring these statutory audits are actually enforced.
So diving into Clause 1 of Section 17, it translates to a simple, totally non-negotiable rule. The registrar themselves, or someone they authorize by general or special order in writing, absolutely must audit the accounts of every single registered society at least once every single year. It is a strict annual guarantee of financial review, no exceptions.
Let's take a closer look at the actual anatomy of this audit.
The law doesn't just vaguely say, hey, do an audit. No. Clause 2 explicitly forces auditors to look at two critical areas. First, they have to do an examination of overdue debts, if there are any. Second, they must do a proper valuation of the assets and liabilities of the society. By legally mandating a check on overdue debts, the Act actively prevents hidden financial instability from, ruining the shared investments of the members.
But of course, an audit is really only as good as the information the auditor is actually allowed to see. To guarantee total transparency, Clause 3 ensures the registrar, the collector, or their authorized person has round-the-clock, unrestricted access to all books, accounts, papers, and securities of a society. Plus, every single officer of the society is legally bound to furnish any required information regarding the transactions and working of the society. Basically, there are zero closed doors during a cooperative audit.
As we wrap up this explainer, consider how these two pillars actually work together. The elimination of middlemen to share economic gains, paired with the unyielding total access audits of Section 17. Together, they empower communities to build local wealth safely and democratically. but it leaves us with a pretty fascinating question to ponder. If this model of shared risk and extreme financial transparency is so incredibly effective at protecting a community's money, why don't we demand that exact same level of statutory scrutiny for all the traditional businesses we interact with every single day?
Statutory framework that an auditor follows to protect cooperative societies. You see, when a business is actually owned and run by the very people using its services, well, the rules of the game change entirely. It takes a completely unique type of financial detective to keep things on track.
It's a critical question, right? Because cooperatives are, at their core, democratic organizations built on equitable contributions. They aren't run by some distant shareholders, they're run by everyday members who are sharing the risks and the benefits. Because of this communal setup, they absolutely need specialized oversight to make sure everything is completely fair and transparent.
So here's our agenda for today. We're covering 5 main areas. First, the auditor's assignment. Second, following the paper trail. Third, enforcing shareholding limits. Fourth, monitoring loans and borrowing. And finally, number 5, safeguarding community investments. Let's get right into it.
All right, jumping right into Section 1, the auditor's assignment, focusing on qualifications and appointment.
Now, you might be wondering who actually gets to do this job. Generally, standard companies require a chartered accountant, under the Chartered Accountants Act of 1949, but co-ops, they operate under a slightly different set of rules. Certain state acts actually allow individuals with specialized local knowledge to step in. So someone holding a government diploma in cooperative accounts, or even a former auditor who served in the government's cooperative department could be appointed. It makes sense, right? It ensures the auditor truly understands the unique cooperative ecosystem.
And what makes this dynamic so fascinating is the chain of command. This auditor doesn't just work for the society itself. No, they are actually appointed by the Registrar of Cooperative Societies. They conduct the whole audit on the registrar's behalf, and then they have to submit their final report to both the registrar and the society. It essentially creates this powerful, independent check on how the community's money is being managed.
Interestingly, when it comes to paying for this audit, especially for credit societies and urban cooperative banks, they don't just bill at some arbitrary hourly rate. Instead, the audit fees are based on a statutory scale that's tied directly to what's called working capital. And by working capital, we mean all the funds at the society's disposal. That includes paid-up share capital, funds built up out of profits, and money raised by borrowing. So the more funds a society handles, the scale adjusts right along with it.
Moving right along to Section 2, following the paper trail, where we look at the specific books of records. Under Section 43H of the Cooperative Societies Act, state governments get to frame the specific rules for the books that have to be kept. So these societies are maintaining incredibly strict, detailed ledgers. For example, in Maharashtra, they're required to keep a cash book, general and personal ledgers, and a property register. You'll also see stock registers tracking inventory day by day and registers logging fixed deposits. But among all these standard accounting books, there is one register that is entirely unique to the whole co-op structure.
And that is the Register of Sureties. This one is absolutely critical. In a cooperative credit society, loans are often given out against just the personal security of members, which then has to be guaranteed by 2 other members. The auditor uses this specific register to track exactly how many borrowers a single member has stood surety for. They need to make sure nobody is exceeding their overall limit. It's essentially a system built entirely on community trust to prevent defaults.
Okay, that brings us to Section 3, enforcing shareholding limits.
So Section 5 of the Cooperative Societies Act of 1912 rigidly dictates exactly how much of the society one single person can own. The auditor has to verify that these statutory limits are absolutely never breached.
Here is the crucial point. No individual member, unless, say, it's another registered society, can hold more than 20% of the total shares, or hold shares whose total value exceeds 1,000 rupees. And the society can't even write a sneaky bylaw to bypass this. It's a hard rule. This brilliantly ensures that a few wealthy members can't just swoop in, buy up shares, and take over what is supposed to be a democratically controlled community organization.
Now let's pivot to Section 4, monitoring loans and borrowing. Here, the financial detective is looking for a very specific contrast. Under Section 29, societies are strictly limited to granting loans only to their own members. If they want to lend money to another registered co-op, they actually need the registrar's prior approval first. But, and this is interesting, when it comes to borrowing money, they have way more flexibility.
Subject to their own bylaws, they can accept loans and deposits from members and non-members alike. Finally, we reach our last section, number 5, safeguarding community investments.
As the statutory audit requirements dictate, an auditor doesn't just look at the cash flowing in and out. They must evaluate the valuation of all assets, examine any overdue debts, and basically guarantee that the community's surplus funds aren't just parked in some random risky account. They have a very strict mandate to follow here.
The auditor has to verify that all investments strictly adhere to Section 32 of the Act. This means funneling community money only into highly secure, legally approved avenues. We're talking about things like investing in a central or state cooperative bank, securities listed under the Indian Trusts Act of 1882, shares or bonds of other limited liability co-ops, or specific banks explicitly approved by the registrar. It is the auditor's absolute duty to ensure these financial boundaries are never crossed.
So as we wrap up this explainer, I want you to consider how this rigorous auditing framework acts as a vital shield. From capping share ownership at 20%, to carefully policing the register of sureties, to strictly restricting where surplus cash can be invested, these aren't just annoying bureaucratic hurdles. They are the essential guardrails protecting the core democratic principles of the cooperative society. It leaves us with a provocative thought. In today's era of incredibly complex, often opaque corporate finance, is this community-first, tightly audited model actually the ultimate blueprint for sustainable, equitable business? Okay, so if you've ever wondered how your local housing society or maybe your credit union keeps your money safe from, well, just disappearing, the answer actually lies in a highly regulated financial playbook. We have a truly fascinating explainer for you today. We're going to dive deep into the strict laws of money management for cooperative societies. You see, a co-op isn't just a regular business, right? It's a democratically controlled organization. It's meant to cut out the middlemen and share economic gains fairly among its members. And because of that unique structure, the financial rules they have to follow are incredibly specific. So today, we're looking strictly at our curated source material to uncover this complete playbook. Okay, let's dive right into this high-stakes question. In a standard corporate company, shareholders might just rely on a board of directors, but in a cooperative society, there's a dedicated financial detective tasked with making sure literally every single rupee is handled correctly, and that's the statutory auditor. The auditor doesn't just look at the math, they look at the law. They are the ultimate gatekeeper, ensuring the co-op plays by the rigid rules set out by the Cooperative Societies Act and the society's very own bylaws.
So here's our mental map for this explainer. First, we'll cover the rules for co-op funds. 2, profit and charity limits. 3, the auditor's general checklist. 4, auditing the income and expenditure. And finally, overdues and bad debts.
Kicking things off with Section 1, Rules for Co-op Funds.
A cooperative society can't just go throwing their money at the latest trending stock or crypto craze. They have a very rigid set of legal boundaries for how they can actually invest. Our sources outline these specific avenues. First, they can invest in securities specified in Section 20 of the Indian Trusts Act 1882. They can also buy shares, securities, bonds, or debentures of any other cooperative society as long as it has limited liability. But it doesn't stop there. They are allowed to park funds in an approved bank or with a person carrying on banking business, provided it's duly approved by the registrar. And finally, they can invest in any other manner permitted by the requisite authority. Now, it is the auditor's explicit statutory duty to ascertain whether these highly specific investment rules are being strictly followed by the society. They are the enforcers here.
Moving right along to Section 2, Profit and Charity Limits.
Now, what's really interesting here is that generating a profit is only half the battle. How a co-op actually distributes that profit is heavily regulated. According to the Central Cooperative Societies Act, exactly 25% of the net profits of a cooperative society must be transferred to a reserve fund. That is a massive chunk of change just locked away. And this mandatory transfer has to happen before any distribution of dividends or payments of bonuses to the members. The law basically prioritizes the long-term safety net of the co-op over immediate payouts.
But, there is a crucial caveat here. The law understands that reality sometimes demands a bit of flexibility, so the registrar actually has the power to look at the specific financial position of the society and reduce that required percentage of profits being transferred to the reserve fund. However, the floor is firmly set. The registrar can never, under any circumstances, reduce it to less than 10% of the profits. That 10% baseline is absolute.
So let's trace the chronological flow of how these profits are handled. Step 1 is that compulsory reserve fund transfer we literally just talked about. Once that money is safely tucked away, Step 2 kicks in, which allows for charitable contributions. According to Section 34 of the Cooperative Societies Act of 1912, a registered society might contribute an amount not exceeding 10% of the remaining net profits for a charitable purpose as defined in the Charitable Endowments Act of 1890. But, crucially, this requires the sanction of the registrar. Finally, Step 3 allows for member dividends or transfers to other reserves. But again, this appropriation must be duly approved by the members themselves in a general meeting called for that exact purpose.
All right, Section 3, Auditor's General Checklist. Now we're shifting from the rules to the reality of enforcement. How does the auditor actually start their meticulous work? Well, Step 1, before looking at a single receipt, the auditor has to carefully go through the bylaws of the society to ensure they are being observed in both letter and spirit. Step 2, they examine the register of members and verify individual shareholdings. And Step 3, they test-check the internal check and control systems operated by the society. This is vital, guys, because the auditor models their entire detailed audit examination based directly on the strengths and weaknesses they uncover right here in Step 3.
Let's jump into Section 4, Auditing the Income and Expenditure.
We are at the absolute core of the audit now, meticulously tracking the money coming in and going out. And this brilliantly illustrates how every single type of cash receipt requires a rigorous, specific paper trail. For share capital, the auditor vouches against the register of members. Cash from sales, that's checked against cash memos, invoices, and the sales account. If money comes in from interest or loan repayments, the auditor goes straight to the original loan agreements. Even cash for house construction or maintenance has to be verified against demands made by the society and money receipts. Absolutely nothing is taken at face value.
And the exact same rigor applies to expenditure. Money going out requires perfect matching. Large capital expenditures must be authorized by the managing committee and matched with bills in the bank passbook. Payments of loans are vouched against loan agreements. Establishment expenses rely heavily on resolutions from the managing committee. You can definitely see the pattern here. The auditor is constantly ensuring that the managing committee has officially sanctioned the money leaving the co-op's accounts.
Finally, Section 5, Overdues and Bad Debts.
This is often the most difficult part of the audit, dealing with money that simply hasn't come back. The auditor acts as a crucial and very serious early warning system here. They have to appropriately classify overdue debts for periods ranging from 6 months to 5 years or more. But they don't just quietly file them away. They must report these to the members, including a specific note on the effects these overdues might have on the overall financial position of the society. Plus, they have to provide a pretty blunt note on the actual probability of recovering those debts.
So the crucial point here is a brilliant little accounting technicality meant to protect the co-op. When a member hasn't paid their debt, the interest on that debt is obviously also overdue. The auditor must ensure this overdue interest is not credited to the standard interest account. Instead, it has to go to a specific overdue interest reserve account. Why? Because counting unpaid interest as active standard income would falsely inflate the co-op's perceived financial health. It's a reality check.
And finally, we come to writing off bad debts. Listen to this incredibly strict rule derived from the Maharashtra Cooperative Society's rules. A bad debt can be written off only when it is certified to be irrecoverable by the auditor. This casts an immense legal weight on the auditor. They must first ascertain that the debt in question was actually created legally within the rules of the society before they can officially certify that the money is truly gone and irrecoverable.
We've seen today how the statutory auditor really is the ultimate financial detective, right? Enforcing strict investment rules, profit allocations, and verifying literally every single rupee in and out. Which leaves us with this final provocative thought. If the auditor is the ultimate gatekeeper of a cooperative society's financial reality, who is auditing the auditors? Thank you for joining me for this Explainer-focused learners. Keep asking those tough questions.
So, think for a second about the roads you drive on, your local clinics, or the sanitation systems in your town or village. Have you ever wondered who actually makes sure the money meant for those public services is being spent correctly? Well, today, we're stepping right into the fascinating world of financial accountability to look at the audit of local self-government. Throughout this explainer, we're going to see exactly how an auditor acts as a kind of financial detective for local communities, making absolutely sure that every single rupee of public funds is accounted for.
Here's a quick roadmap for what we're going to cover today. 1. The local governance system. 2. Following the public money. 3. The objectives of auditing. And 4. The auditor's playbook.
All right, let's jump right into Section 1,
The local governance system, foundations of local power. So, the origin of all this local power is actually constitutional. In India, local self-government refers to governmental jurisdictions just below the state level, and the real game changers here were the 73rd and 74th Amendments to the Indian Constitution. These amendments were huge. They radically formalized local power by recognizing a formal system of governance at the local level across the entire country, and that goes for both rural and urban areas. State legislations are what actually give the real power to these organizations. And honestly, the most important part, all of these local bodies are operated by representatives who are elected through a democratic process, which means every single citizen gets a voice in how things are run.
Now, this power is distinctly separated between urban and rural local bodies, and each is structured into very specific tiers. On the urban side, you've got municipal corporations or nagar nigams for the largest cities, municipalities or nagarpalikas, and notified area councils or town panchayats. Then, over on the rural side, self-governance is structured in three really clear layers. You have the Zilla Parishad at the district level, the Panchayat Samiti at the block level, and the Gram Panchayat right down at the village level. It's essentially a highly organized, layered system of administration that's custom-built to manage localized needs.
Moving on to Section 2, following the public money, the stakes of governance.
So these local bodies have a massive list of functions delegated to them by the state governments. But to actually pull off those functions, they need capital. Which begs the question, where exactly does the money come from, and where does it go?
Before we even look at the balance sheets, we have to establish one fundamental truth here. These organizations deal with public money. This isn't some corporate profit margin we're talking about. This is your money. Whether it's collected through local taxes or distributed via state grants, it represents the collective wealth of the citizens. And it's completely entrusted to these local bodies for the development and the maintenance of the community.
Think of it like a pipeline. State grants are issued specifically to execute sanctioned projects, while local taxes serve as a direct, local source of revenue. This money is then channeled straight into those delegated functions we talked about. Urban bodies are spending this on things like public health, public safety, education, public works, and general administration. Rural bodies, on the other hand, use it to plan, coordinate, and implement various national programs. And both sides are deeply responsible for maintaining the public assets they create with those funds.
Which brings us to Section 3, the objectives of auditing, ensuring accountability.
Simply put, because these organizations deal with public money, auditing their accounts is of immense importance to ensure transparency and accountability. We absolutely must rigorously scrutinize the books of local governments, because at the end of the day, transparency is the only way to protect the public's trust and verify that those funds are actually being used appropriately.
When an auditor steps in, they're really targeting 4 core pillars. First, they need to ensure the fairness and correctness of the financial statements. Second, they report on the adequacy of internal controls. Third, they verify that the full value of money is actually received on the amount spent. And fourth, they actively work to detect any frauds and errors. By hitting all 4 of these marks, the auditor ensures the local body is operating honestly and efficiently.
And finally, Section 4, the auditor's playbook, the financial detective.
So how do they do it? Well, there are official guidelines that serve as an exact playbook an auditor uses to kick off their investigation. It outlines a very strict set of procedures and general points that an auditor has to consider when they're examining local self-governments. Let's break down exactly how this process works step by step.
The investigation always starts with the legal and procedural foundation. The auditor first has to make sure their own appointment actually aligns with the local body's regulations and that they're approved by the right authority. Then, they have to get a really detailed understanding of the specific rules governing the organization's financial control and accounting. Finally, they kind of act like historians. They consult relevant documents, minutes, and resolutions just to know exactly what decisions were made behind closed doors before they ever even look at the numbers.
Once that foundation is rock solid, the auditor tracks the cash. For various government schemes, they check the exact utilization of grants, making sure that appropriate authorization is maintained at literally every single step. If funds were provisioned for something, the auditor guarantees the actual expenditure came directly from that provision, and maybe most importantly, that the spending was signed off by a competent authority. Absolutely no unauthorized spending is allowed to slip through the cracks here.
Then we reach the most intensive phase of the playbook. This is where auditors apply in-depth investigations into areas that are just notorious for potential fraud. Stuff like revenue collection, various waiver schemes, and the use of casual labor. They are actively hunting for red flags. And when huge financial expenditures are involved, it's not just about making sure the math adds up. They actually have to verify that the schemes ran economically and generated the targeted outcomes. In other words, did the community actually get the value they paid for?
Which brings us to our final thought for today. We've looked at the constitutional structure, we've traced where the public funds go, and we've walked through the really meticulous steps an auditor takes to protect those funds. But theories and guidelines only go so far, right? The real impact happens right in your own backyard. So I want to leave you with this question. How transparent are the books in your own local municipality? Are the targeted outcomes actually being generated in your community? I really hope this explainer has empowered you with the knowledge to start asking those very questions. Keep learning, stay curious, and thanks for joining me today.